Good morning, John. It's good to see you. We're recording this on Thursday. Two bits of news out today. This morning, we found out that the CPI in the US was slightly better than expected, down from 3.4 to 3.3. And the market seems to have taken heart from that, with the S&P 500 and the NASDAQ both hitting all-time highs. John, what did you make of the inflation data out of the US?
Well, I thought the number was pretty darn good. I mean, it was zero for the month. And it's amazing how when you get such a good month, then all of a sudden people start looking about 12-month numbers. If you look at 6-month numbers and double it, which I think is always more relevant, you get numbers close to 3% as the run rate. And that's after a couple of bad months. The 12-month figures pick up a very bad August last year, where we had a 0.5% monthly increase in the CPI in America. So that's going to carry forward in 12-month numbers looking back until August. And by September, it looks like inflation on the 12-month look back will be below 3%. So it's heading in the right direction. And I think there should be every confidence that interest rates will be cut in the second half of this year, probably after September. And the market's adjusting to that, the bond market and the income markets, the debt markets. That gave a bit of a kick to the equity market, but more so in the NASDAQ, I guess, usual stocks. But I'd say it's a good number, and look forward to interest rates coming down the second half of this year.
And in Australia at 11 this morning, we got the labour numbers. I think the jobs count grew. I think it was 39,700, something like that, and unemployment ticked down from 4.1 down to 4%. So that seems to be showing real resilience. Starting to get the feeling that growth was really sluggish, but this seems to indicate that got capacity to still generate new jobs. What are your thoughts?
Well, the economy is growing. I mean, it's just not really growing when you take out population growth and take out inflation. That's where we're going backwards. But in terms of growth terms, we're growing, and that's what's being picked up in the employment numbers. When you, as I keep on saying, we immigrated nearly 1 million people over 3 years. We may well be cutting back on immigration, but people come into the economy, and anyone who's come into the economy in 2023 is moving into the workforce in 2024. We're seeing the benefits of that. Then those people themselves, earn a wage, and they start consuming, and we get the compounding effect going through the market. So through the economy. So there's nothing surprising about it. I don't know why there's this eagerness by anyone to drive up the unemployment rate as if it's going to be some panacea to the inflation numbers. It's quite clear, looking at inflation, the reason inflation came down in America is because energy prices and gasoline prices were negative in the last couple of months. The only thing that's really positive is the cost of rental, accommodation, very similar to Australia. So once Australia starts bringing down the cost of electricity, brings down the cost of petrol, we'll have lower inflation. It's got nothing to do with employment. It's got something to do with wages. And I just think there's too much focus on trying to create an unemployment rate in Australia. We should be trying to create a growth rate in Australia at a low inflation rate. And I think the focus of economic analysis is quite poor at present, but that's consistent with my view, which I keep on saying this is a cost inflation cycle, not a demand-driven cycle.
John, you referenced the price of electricity. It gives me that the price of electricity in international terms in Australia is relatively high, and yet we are an extremely rich energy exporting country. This is one of the real divides between the Labour government and the opposition coalition. Recently, the SIRO came out with a report about energy in Australia, saying that they regarded nuclear energy as not being economically viable, as the opposition is talking about nuclear energy as one of the planks of their platform. Do you have thoughts on this, sir?
Yeah, well, it was interesting. I was listening to a podcast like last night from an American politician from the South, who you would think would be have some bias towards carbon. But he made the point, and I think it's very relevant to Australia. He's talking about America should have a multi-focus on energy, so a multi-supply focus from a whole range of sources. And he made the point that if we, for instance, if America went heavily into solar, and I take the same point for Australia, where are these solar panels going to come from? Substantially come from China. Now, I don't want to get into geopolitical worry about China, but he made the point it would be very strange for America to go aggressively into green energy and rely on China as a major supplier of the solar panels, for instance, needed to do that. His argument, which I sort of agree with, is diversity of supply for a whole lot of reasons is a logical way to go. He also made the point that he saw no reduction in the growth of power needs of America in the next 20 or 30 years. Now, whatever their growth and power needs are per capita, I think Australia's will be the same per capita, but our population growth will be much faster as a percentage than America. So I actually see, and I did some numbers which I shared internally yesterday, I see generation needed in Australia going up 50% in the next 20, 25 years through population growth. And maybe if we create some new industries which need power, that'll be another tailwind. So not only are we got to think about replacing the current carbon production of energy, we've got to actually increase it by 50% over the next 25 years. And to do that, I think you need diversity of supply. And that's where I think nuclear comes into play. It might not appear viable, but when you look at the cost of doing it over the next 15 or 20 years and consider how the Australian economy is going to grow by 50% in dollar terms today, in current dollar terms, we will be probably a $3.5 trillion US economy, maybe, depending on the Aussie dollar, we might be $4 to $5 trillion. The amount of money we're talking about spending on nuclear, which will have tremendous life, will need less money reinvested in it once it's built. Once it's built, then you don't have to reinvest, whereas solar panels and batteries do have a life, which will require constant replacement. And if we don't have a viable source of manufacturing of solar panels in Australia, or from a friendly country, a friendly trade country, then we are putting ourselves at risk. So I think there's a lot more to energy than the cost of it. I think we've got to think building something which utilises Australia's natural advantages, and I don't say that sun and wind are not Australia's natural advantages, as is excess land. But crikey, we have a lot of uranium in the soil, underground, and if we don't use it, someone else may well use it. And Australia is one of the few Western countries in the world which doesn't have nuclear energy anyway as one of its sources of supply. So I think this, as I said, I think a few weeks ago, the energy debate's got to get away from a debate between left and right and the Greens in the middle to an agreement nationally of what we want to achieve and how we're going to meet the substantial growth and energy needs of this country in the next 25 years rather than talking in today's terms. And I also think we should focus in on net as opposed to gross. Australia is one of the few countries in the world where we do have substantial forests, going all the way up the east coast of Australia. There's a lot of, and we can do a lot more in that area to do carbon offsets. So I just look at the debate and I think it's a little bit, I won't say it's biased, but I just think it's getting to the point where we need to take the political debate out and get to one consensus and have a 25-year plan and just agree it and get on with it.
Mm. Yeah, there were a couple of things that crossed my mind as you were talking about importing solar panels from China. The majority of China's power is generated from coal-fired coal-fired power stations, and they'd be manufacturing the solar panels, but at what cost are they? And then it's also interesting that a country like France generates something like 70% of their electricity needs from nuclear. And without having any resources of its own, it seems to have cheaper electricity prices than most other European countries. So quite interesting. Anyway, John, just heading overseas once again, in the European parliamentary elections, there was a marked shift to the right. And President Macron of France has called a snap election. We've got an election up in the UK where Rishi Sunak called an election. Obviously, got the American presidential election coming up in November. All this political uncertainty, markets generally don't like uncertainty. Is this worrying you, or do you expect markets to start discounting some of these results, or perhaps trying to hedge their bets and so on?
Look, I think the more compelling issue is the reduction in interest rates, which is going to occur in the next 12 and 18 months. We've already seen it start in Europe, and we've seen it start in Canada, and we'll soon see it start in America, the US, and then it'll come to Australia. So I think that's what's going to drive markets longer term or medium term, and that's what we're investing in. In terms of political movements, I think it does suggest, Paul, there is a range of protest votes occurring because the average person, particularly the person who's on an income below average, is getting slaughtered by the cost of living, not only in Australia, but all around the world. And whether it's a drift to the right or left, it's just a drift away from the incumbents. The incumbent governments are blamed for the problems. So it's not a drift anywhere, it's a drift away from incumbents. So you don't want to be an incumbent government at present because you're going to get a protest vote against you. Because, and particularly in France, I suspect the cost of living is one issue, but also the loss of control of their borders and the immigration issues, which seem to be dominating some of that political discussion. So I think there's a whole lot of reasons. Does it affect markets? Look, it's a trade. If there's a shock election, there's a big shift to the right or big shift to the left, in different parts of the world. I think the UK is going left, France is going right. Does it mean anything? I don't think so. But it gives, again, the traders something to trade about, They can trade it. And I think European markets were hit when the announcement was made, wasn't it, by Macron? Yeah. And now they're up again last night based on the fact that US inflation. So they're all trades. They're all day trades. And I just think I just watch it and go, really? What's happening in the underlying economy? And, the world economy, as I said, I've been saying in my presentations, I'll say it again next week in Melbourne, the week after in Sydney, the world economy is not going into recession. The big issues are cost of living and how does the average person catch up? And if he doesn't catch up, he'll have a protest vote. In Australia, it's the cost of housing, which is the biggest issue. And I've been saying in my presentations, it's the cost of housing and having no policy which could see a protest vote against the incumbent government in this country.
John, last question because we're running out of time. The bond markets seem to have been fairly relaxed about the last couple of months movement in inflation and perhaps the deferral of rate cuts. We saw bond market knocking on the door of about 5%, the 10-year bonds, both in Australia and the US, maybe 6 months ago. They've come all the way back to 4.25%, 4.33%. Do you think we've seen the top in bond yields, and is now a good time to be investing in bond markets?
Look, just talking to our bond managers and the amount of corporate bond managers in Torrek, and our fixed income managers and income managers in Climb, I think we all agree that, the sweet spot in the bond market is between 3 and 5 years. 10 years, you might make a bit of money on a capital gain, but 4.3, 4.2% on a 10-year bond coming out of a period where inflation peaked at 8%. And who knows what's going to happen in the future. Projecting out 10 years, I just think it's a terrible investment. That sort of yield doesn't compensate you. It's great for governments who can borrow at that rate, and that's the biggest issue. But I just don't see 4.2. But it does support the equity market. As I always say, it's the risk-free rate of return that drives the equity market, and the bond market long-term rates are very, solid. German 10-year yields are 2.5%, Japanese are 1%. I mean, so there's a relative argument to buy Australian bonds if you're an international investor. But crikey, I just don't see much value there. If I'm going to buy bonds, I'd be sticking around the 3 years for government bonds, and I'd be more focused on corporate debt through our fund managers in Torrica and other fund managers. I just wouldn't be buying government debt anywhere at present. And I certainly wouldn't be drifting into international government debt using Australian dollars at present. I just don't think there's any logic in doing that. So I'm just saying, look, I'm watching it. It's good news that yields have come down, but would I want to trade it? Absolutely not. I just think the bond market's still suffering from 10 years of printing money prior to COVID and coming out of COVID. So the bond market's still trying to work out what fair value is. I don't think 4.2% is fair value for a 10-year US bond when they're going to run this year 5.7% deficit on fiscal, 5.7%. I mean, and they're growing at 3%. So they're growing their debt. And there used to be a theory in economics, Paul, that supply and demand worked out the clearing price. If you increase supply, which is what you're doing when you run a 5.7% deficit, then all things being equal, the bond market yield and the price of a bond should be falling because there's too much supply. Yield going up, price down. But somehow that's not occurring at present. So we've just got to watch out what's going on in the manipulation stakes going on in the bond market of America at present.
And who knows what the debt level will be under President Trump 2.0. So a lot of
uncertainty. That's a big forecast.
Yeah.
Is that your first forecast?
The Economist wrote a piece today or yesterday saying that their model suggests that Biden's chance of being re-elected is only about 30%, and they think Trump has about 2/3 probability. But anyway, that's one view. We'll have to end it there. Thank you very much, John. Always interesting to talk with you, and we'll see you next week.
See ya.